And welcome everyone to another fine town hall session. My name is Mark Johnston. I'll be your moderator today, and we have the great privilege to focus here on gold royalty. And of course, we have once again our special guest, David Garofalo, who is CEO and chair. And we're joined today by John Griffith, who is the chief development officer, to discuss recent transaction in the market and where things are for the new and revised company moving forward. Gentlemen, thank you for joining us today.
Thanks for having us on, and I'm delighted to welcome all of our shareholders, old and new, into the tent today, so we can talk about our story and remind you why this transaction was so compelling for shareholders, why we're so well positioned right now for a rising gold price environment. I have the delight to have my partner and collaborator, John Griffith, our Chief Development Officer, to come in and talk specifically about our asset base, the compelling nature of it, the leverage we provide to gold within that asset base, the exploration potential. We're extremely well positioned amongst our peers to really provide significant value accretion for our shareholders. We've already realized a very significant re-rate as a result of this transaction. You've been a beneficiary of that. We'll talk about that in a bit more detail later on. But more importantly, we're here to answer your questions as well. And we're delighted you're able to join us and ask any questions you want to ask about the transaction that was just completed last week. Congratulations to our shareholders, both old and new, in completing the transaction and joining the larger and newer entity. But we'll take all the time we need at the end of our presentation to answer any of the questions you might have about the transaction, about the company going forward, and its prospects. So with that, I'll just, again, to remind you about the characteristics of Gold Royalty, that really, I think, make this a compelling investment proposition for you as shareholders. We've created a leading growth in America's focused precious metal royalty company with over 100 royalties within the portfolio. So we're well diversified, but we're not diversified in terms of our political risk. We're focused squarely on low political risk jurisdictions in the Americas. And we're not diversified in terms of our minerals. We're squarely focused on precious metals. There are a lot of our peers that have much more diversified exposure to metals, exotic and otherwise, other than precious metals. And we think that dilutes the brand. We think that dilutes the leverage proposition to gold. It dilutes the multiple, raises the cost of capital by being squarely focused on low political risk jurisdictions, but a diversified gold portfolio with over 100 royalties. We provide, importantly, the leverage to the gold price, leverage to the exploration success of our underlying operating partners, but provide access to capital on a low-cost basis because of our focus on gold. The reality is precious metal-focused royalty companies get the best multiples. Ones that dilute that brand tend to see their cost of capital go up and they become uncompetitive. That's a vicious cycle that you'll never find us go into. And so staying focused on low political risk jurisdictions, precious metals is really going to be the signature strategic focus of our company. We have a clear path to re-rate. It's a very diversified portfolio in terms of the number of assets, but also the stage of these assets, really from early stage exploration right through to production. We have 4 cash flowing assets currently, a number of them in development that will bring significant cash flow growth over the next 4 or 5 years. And John will get into that in a bit more detail in his part of the presentation. But we really provide the best of all worlds: leverage the exploration, leverage the gold price, growing cash flows, and a very stable cost structure. It's a very scalable business, and that means that we can add a lot more assets into the portfolio without having to increase our G&A expenses. We can, I think, quite capably run a business almost 10 times the size with the same employee base that we currently have. So that means as we add royalties into the portfolio, it goes right to the bottom line for our shareholders in terms of free cash flow. And we're well positioned. We've exited this acquisition with still a strong balance sheet, over $11 million in cash. We're negotiating a new credit line as we speak to add further capacity in order to continue to add to our portfolio. And we have no debt on the balance sheet. So we're in a very enviable position in that regard, and that will make us cost competitive and cash competitive as we look at new royalty opportunities to supplement what's already a very, very strong portfolio of royalties. And again, what distinguishes us from, I think, a lot of our peers is the depth of our organization across the board. Our board and management brings not only royalty experience, but operating experience. Over 300 years collectively on the operating side. Many of you will remember that I came from an operating background. I've spent over 30 years building mining companies. And that's true for many of our board and management, which is a unique advantage when you compare us to our peers, because it gives us a clear-eyed view of the underlying risk associated with the assets we're going to invest in and take royalties back in, but it also gives us significant access. We can call up any company in the world, and that'll give us an advantage to get into bilateral opportunities for royalties before they become available to the rest of the market in a competitive process, which tends to drive up costs and lower rates of return. So I think those are the key advantages of the company. It's the personnel, the diversity of the portfolio, the strength of our balance sheet, our ability to access capital markets, as we clearly demonstrated when we did our IPO back in March and raised $90 million US with an order book of over $140 million. We can access this capital with this management, and we can certainly enhance our ability to access capital given how diverse our portfolio of royalties is now. Really, what I want to do is spend a couple of minutes talking about gold as an asset class. It's a good day today. Gold's up again. We're up above $1,800 an ounce, and it's clear to me, and I think to many of the watchers in the market, that the Federal Reserve, or for that matter, any of the central banks in the world, are not in a hurry to raise interest rates, and not in a hurry to taper or reduce quantitative easing. In other words, that's a euphemism for printing money. They're going to continue to print money with reckless abandon. That's hugely constructive for gold. We're likely to see much higher gold prices than we're currently experiencing. In fact, while we achieved $2,000 an ounce in this current cycle, and that was an all-time high, that was the nominal high. That was not the real high. The real high was what was achieved back in the early 1980s, when gold was about $850 an ounce. In today's dollars, that's $3,000 an ounce. We're in that kind of dynamic right now. We're experiencing significant inflation across the general economy. We're seeing cost inflation within the mining business. And I think in that environment, we expect to see all-time cyclical highs in gold again, particularly given the unprecedented amount of quantitative easing, unprecedented level of interest rates. It's easy money right now. Gold will benefit from that because of its scarcity value. And so getting to $3,000 an ounce in this cycle is entirely conceivable. And beyond that, given the amount of new printing or printing of new money that we've seen, our fiat currencies. The other dynamic I think that's going to be hugely constructive for gold is the fact that reserves, as this chart demonstrates, has been steadily declining over the last 7 years. From peak levels back in 2012, we've seen reserves come down about 40%. And so that downward trajectory is unlikely to reverse anytime soon because of the significant underinvestment we've seen in exploration across the mining sector. And that's why it's so important to be positioned in the royalty business right now, because this is coming to roost. The miners are going to have to reinvest back in exploration, reinvest back in development, and they're going to need access to capital to do that. And what royalty companies provide is a much more cost-effective source of capital for the producers to build out new capacity, to do exploration. And in providing that capital, we're taking back royalties on large geological deposits with significant exploration upside for our investors, and insulating them from the cost inflation that I think is inevitable in this sector now that there's going to be an avalanche of capital invested back in exploration and development, and we're dealing with the backdrop of significant inflation in the general economy as well. So if you look at past cycles, why be in the royalty space? Well, really, in any cycle in the gold business, royalty companies have outperformed. And if you're looking back 10 years ago, when we saw rising gold prices, when gold last achieved peak highs of just over $1,900 an ounce back just post the credit crisis, we saw the gold companies actually underperform. These are the mining equities, significantly underperform the actual commodity and dramatically underperform the royalty companies. Because what was happening 10 years ago is we saw dramatic input cost inflation. And as a result, that undermined the leverage proposition that investors were looking for in gold equities or gold mining equities, because their margins were not expanding as the gold price was going up. Investors became disillusioned and focused their capital to the extent they were participating in the gold market in the royalty businesses, which provide top-line exposure, but none of the risk associated with capital and operating cost inflation. So you saw the royalty companies vastly outperformed the gold mining equities, and for that matter, the commodity in a significant fashion. Then we went through a bit of a nuclear winter in the gold business, and for that matter, in the base metal business as well, with exceedingly low metal prices. And even in that environment, on a relative basis, the royalty companies provided protection. So costs did stabilize. The mining equities got their balance sheets in order. But even with that, even as they returned capital to shareholders in the form of dividends and share buybacks, the operating companies, they still underperformed the royalty companies, which provided steady cash flow in every environment. And I think where we are today is we're back into the cycle we saw 10 years ago. So as I go across this graph, I'm talking to the left and the center and now the right graph on the top. We're back into a rising gold price environment because of the significant underinvestment in exploration and development that I alluded to in the previous slide. Guess what? We've seen this movie 10 years ago. We're going to see massive cost inflation again. Both the base and precious metal companies are experiencing incentive prices for construction and exploration. Copper is north of $4, all-time highs on a per pound basis. Gold is approaching all-time nominal highs. We're at incentive prices. So we're going to see, out of existential need, mining companies on both the base and precious side allocate significant amounts of capital to exploration and development to reverse the downward trajectory they're experiencing in reserves and in production. And as we see input cost inflation, again, I think that undermines the leverage proposition that gold mining equities are supposed to provide. And I think the royalty space is where you should be, where you have top line exposure without the bottom line risk associated with operating and capital cost inflation. So we're insulated. We're providing you the best of all worlds. So you could certainly buy the ETF and the physical, but unfortunately, when you buy a bar of gold, it doesn't grow. And in fact, it takes away a little bit from your savings because you have to pay for storage costs. When you're buying a royalty company, you're getting that leverage to the gold price as it goes up, but you're also getting the leverage to exploration success as these companies refocus on exploration, drill out their deposits, grow them geologically. We benefit from that because we have a royalty on the whole property, not just on the existing deposit. So as the deposit grows geologically, our shareholders benefit. And because this business is scalable, our costs don't go up as we add royalties. Again, those revenues, incremental revenues, go right to the bottom line. And that's really why the royalty business is the best of all worlds. And why at this stage in my career, after over 30 years in operating, I position myself at this end of the spectrum because I think that there is a significant need for mining companies to reinvest back in exploration and development. But frankly, I don't want to be exposed to the massive cost inflation that's coming in the mining sector. So with that, I'd like to hand it off to John Griffith to talk a little bit about the recent transaction and our prospects for our existing portfolio of royalties.
Thank you very much, Dave. And what a pleasure to be on the town hall today. I want to just echo a lot of what Dave said about what a wonderful portfolio we have, but also to say that it's an enormous privilege for me to be working with Trey and Jerry, who really were fundamental in building up Ely, and we are enormously privileged to have them as part of our team going forward, and very excited to be able to continue with much of the work that they did to build Ely in our new company going forward. Before I get into any of the detail, I'd like to just talk a little bit about the value creation that occurred from our transaction. And so I'll refer to slide 5 in our presentation. And what this shows you on the left-hand side of the page is really the unaffected market capitalizations of both Gold Royalty and Ely upon announcement of the transaction. And we use unaffected market capitalizations to avoid any noise related to the transaction. The aggregation of Gold Royalty and Ely's market capitalizations totaled $361 million at the time of announcement. We do look at an adjustment to that market capitalization to take into account the fact that overall the sector has actually traded down fundamentally due to volatility in the capital markets and gold price movement. And the way we measure that relative performance is by looking at the GDXJ ETF as a proxy for how our peers have traded relative to our own stock. And you will see that we highlight here a 12% degradation in that market cap due to market performance, or the equivalent of $42 million US. And that is how we get from the $361 million pre-announcement market capitalization aggregated for the two companies to the adjusted $318 million merge-co market cap. And we then look on the far right at where the company is trading today, and in addition, the cash that was dispersed to Ely shareholders. The cash equates to 67 million US. If you'll recall, it was 84 million Canadian. So translated into US, that's 67 million. And the uplift in the market cap from 318 to $369 million is approximately $52 million. So the $52 million uplift in the shares plus the $67 million in cash is value that's been created here. That is a total of $119 million, or 37%. This obviously was measured when we created the slide, measured it based on the closing share price on August the 24th. So a tremendous amount of value created. The re-rate has begun, and we're very confident that this is merely the beginning of what's going to be a very rewarding and exciting journey. So if I move on to the next slide, I'd like to talk a little bit about the portfolio. And I think one of the things, we have a lot of statistics on this page. There are a few things that I'd like to highlight. I think first and foremost is really the balance of the combined portfolio. Dave did mention the 4 producing assets. I think within that 57 development assets, we really need to drill down and look at, there are a good number of assets that are what we would describe as in production. And then beyond that, a good number of assets that are in the pipeline following very closely beyond that. So the portfolio offers current cash flow. It offers tremendous growth in the near term. It's got fabulous growth in the medium term and tremendous optionality in the longer term. The attributable ounces that are associated with the royalties in this portfolio are approximately 600,000 ounces, which puts us right near the top, if not at the top of our sub-billion-dollar peer group. And the exciting thing is that the growth that's going to come from those 600 million ounces is very balanced over the immediate term, the intermediate, and the longer term. So it's a portfolio that is balanced far better, in our opinion, than any of our peers. And again, if I say that we weren't to do another transaction, there would be tremendous organic growth delivered from this portfolio. But we're not going to sit on our hands. We're very active from a corporate development standpoint. And as I mentioned, particularly excited to be working with both Trey and Jerry going forward to continue to grow the business. I think, again, Dave mentioned the financial profile. We don't have any debt, $11 million US of cash, and a street estimate of $6 million of revenue for the next calendar year. So we really are exceptionally well positioned. Talk a little bit about the shareholder profile, which you will see on page 6. On a pro forma basis, we represented 43% in terms of Ely shareholders given the cash uptake. That means, by definition, 57% of the ownership is from the maiden GRC shareholder base. And then we highlight a couple of key individuals, Eric Sprott, who's just under 8%, and then the parent company of Gold Royalty, Gold Mining, at 28%. There are still, from a point of view of shares outstanding, 72.5 million, 17.1 million warrants and options to give us a fully diluted share count of 89.6 million. If I may turn to the next slide, talk a little bit more about the portfolio in detail. Dave mentioned the geopolitical risk profile across the Americas. There isn't a peer that can really compare to our geopolitical risk profile. But even within the Americas, if you were to focus in on both Nevada and Quebec, they would be our two most prolific regions, both in terms of assets, number of assets, but also in terms of our net asset value, with Nevada representing almost 2/3 and Quebec representing almost 15% of our value. So those are two regions that are incredibly prolific in terms of mining, but also very mining friendly. Again, I want to really draw your attention to that, because having a geopolitical risk profile that is America's focused is one thing, but to have so much weighting in two key regions that are fundamental to our industry is even more compelling. I mentioned also the balance across the portfolio, and I think you can see that to an extent in the pyramid that we've shown you on the right-hand side. 4 producing royalties, 10 royalties in what we would describe as the near production stage. So that, again, speaks to that very compelling growth that you're going to see in the intermediate term. And then the optionality provided in the medium and longer term by the additional assets that you see we've highlighted in our development stage assets and then exploration stage assets. It's just a tremendous balance to this portfolio. But we are actively looking at other opportunities. Again, as I mentioned, working with Trey and Jerry to continue to grow the portfolio beyond what we have today. If I move on to the next slide, wanted to just highlight for a moment one of the key assets in the portfolio, tremendously exciting for us to look at Fenelon. And I think it has the makings of being a giant. Wallbridge Mining is nearing completion of its drilling program at Fenelon, which will feed an initial mineral resource estimate expected in Q3 of this year. Wallbridge has also released further drill results that reinforce the possibility of bulk mining at Fenelon. The company's begun switching focus from infill drilling to extension and exploration beyond the known resource area as its infill drilling program wraps up. So in aggregate, over the past 3 years, Wallbridge has drilled approximately 260,000 meters, which will all be included in the Q3 resource estimate. Results included in the company's August 5th press release continue to show promising grades and widths, including 3.75 grams per ton over 27 meters at the Tabasco Cayenne contact zone, and 1.93 grams per ton over 13.5 meters in Area 51. A potential development scenario at Fenelon could consist of an open pit at Area 51 and an underground mine targeting high-grade core of Tabasco and its surrounding areas. We'll certainly be looking eagerly to the Q3 resource announcement to see how the low-grade halo will impact the higher-grade core of the Tabasco and Cayenne zone specifically. Many sources have suggested that the resource estimate at Fenelon could be upwards of 5 million ounces, with roughly 2 million ounces of high-grade core at Tabasco, 2 million ounces in Area 51 open pit target, and a further 1 million ounces of the remainder of Tabasco and other areas. So again, a tremendously exciting and compelling asset for us, and that I think is going to be very instrumental in driving value for the for our shareholders going forward. I'd like to talk a little bit about our royalty generation program. This morning, you may have noticed a press release announcing our investment, private placement in, and strategic alignment with PRC. What really excites us about this opportunity is the work that the PRC team has done to develop a proprietary digitized database. And what this database does is it identifies either orphaned or previously unknown royalties and marries that over geographic terrain, geologic data, and provides a tremendous tool for identifying royalties that we can collectively pursue. When you combine that with the work that Jerry and Trey have done in Nevada, what this really is going to do is allow us to identify and continue to pursue royalties on a bilateral basis. While many of our peers are participating in auctions and competing for price competitive assets, we're able to pursue bilateral conversations which generally are going to yield a much higher return within our portfolio once we conclude those transactions. So it is tremendously exciting for me to be leading the corporate development team and have these two extremely powerful tools at our disposal to continue to grow our business in a very effective manner and to not be beholden to pursuing only processes in which many of the competitors are driving down the internal rates of return of those particular opportunities. And I really don't want to understate the power of this really unique combination of features that we have inherited in Gold Royalty, and it really is going to be instrumental in driving growth going forward. That's not to say that our growth is going to be entirely based on pursuing individual royalties. We will also look at the auctions of royalties that are being sold, because we oftentimes are able to identify key operating or geological criteria that others may miss that could be certainly value enhancing for our shareholders. And then finally, we will also continue to pursue the opportunities that are presented by a very abundant and prolific group of peers. We certainly see further opportunity for consolidation. And we certainly, again, feel that there is further upside in the re-rate of the combined portfolio. But there's also a very compelling reason to get bigger in this industry. Operating scale, capital market scale are important, and I'll talk a little bit more about that in a bit. The one thing that is very important to us, but unfortunately we do not have any direct control, is the environmental, social, and governance practices, or what we refer to as ESG. Gold Royalty is committed to responsible mining in all aspects of its investments, including with regard to ESG matters. Inherent in our strategic initiatives, Gold Royalty plans to focus on partnerships with mining companies that share the same ESG philosophy and a commitment to promote responsible and sustainable mineral development across the portfolio. It's a core element of our business model that successful mining projects create sustainable benefits for all stakeholders, including our shareholders, local communities, and also project employees. Sorry, I'm just catching up with the slides there. Now, I'm going to hand back to Dave to talk a little bit more about the board and management team.
Well, we keep adding strength on strength, and of course, missing from this array of photos is Jerry and also Tim, both of whom are going to be instrumental in helping us with our generative program in Nevada and more globally, respectively. So I'm delighted to add them into the mix. And as John said, they're going to provide powerful tools for us to generate our royalties internally. And the good thing about generating these things organically is you're not competing with anybody to do that. And we're using two very, very capable and experienced prospectors in Jerry and Tim to generate those exploration ideas, stake properties, and then farm them out and taking royalties back on them without putting any serious capital work. That's how over 100 of the royalties we inherited from Ely came to be. And so that's a tremendous competitive advantage. And again, given the depth of operating and mine development experience within this board, we have, again, the capacity to do significant due diligence on opportunities, get a clear view of the value and the geological potential of what we're looking to assemble and put royalties on. And create significant value opportunities for our shareholders, expecting to get double-digit rates of return on the capital we're allocating. And again, this group also gives us access. As I said earlier on, it's a very, very capable group and a very senior group that's operated senior large-cap mining companies, which means we have access to other large-cap mining companies that might have royalties in their portfolio that we're looking to realize value on. So that's a significant advantage we have within this group. In the operating partners that we have, very diversified, very capable. We've diversified that significantly since we launched gold mining in our IPO gold royalty, just this past March. And that operating group is not only capable from an operating perspective, but they also have very, very good track records from an exploration perspective. And that's really half the equation on the royalty side. It's a leverage of the gold price, but also leverage the exploration success, because these royalties encapsulate the entire property. So as these deposits grow geologically, you're exposed to that without being exposed to the underlying operating capital risks. And, we've had a number of questions I've seen on the Q&A about our share price performance. And what I would say there is, we were able to satisfy many of the shareholders who opted for all cash. In fact, they got the majority of their consideration in cash, subject to the limit. But there are a number of shares that ended up in hands that, are probably looking to take a profit off the table after having a decade being invested in Ely. And what I would say to you is, don't forget that we are in the GDXJ. We graduated to that shortly after our IPO. There will be a rebalancing in the coming week or so, which means given the doubling of our size, there will be a significant influx of demand for our stock from the index funds. And I would say that we'll start to see that re-rate reflected in the share price performance in fairly short order. And with that, Joanne, we'd be happy to invite questions.
Terrific, gentlemen. Thank you very much for the tour through what's happening currently at the company, and a lot of great new information. We have a very busy Q&A column here, gentlemen, so we're going to jump right to it. Just an overall general question, because there's a lot of energy around this particular topic. So David, to you specifically, we're getting a lot of questions regarding when the GROY shares will trend back up after the transaction. Any thoughts on that?
Yeah, so as I just referenced, I think there are a number of shareholders who are opting for all cash, receive some stock, a small fraction of stock. They may be looking to liquidate. They've had a good run with Ely over the last 10 years. Trey and Jerry created tremendous value.
Mm-hmm.
There's still significant value to be created here on a combined basis. And I understand that some shareholders may be taking their cash, but what I'm saying is that there's going to be significant index buying in very short order.
Mm-hmm.
Because as a member of the GDXJ, GROY is, Gold Royalty, we're going to experience a significant reweighting on that index in the coming week or so.
Mm-hmm.
And there will be an influx of index buying as a result of that. A significant, we're talking about potentially millions of shares of demand coming in very short order.
Terrific. Thanks very much for that, David. Just to look back a little bit too, that's a great way for us to look forward. But looking back, can you provide some of the mechanical information? A question comes in, absolutely applauding your talking points are very compelling. But in light of that, how do you explain the fact that the share price fell from 4.98 when you announced the Ely acquisition to 4.13?
Well, it's actually had quite a ride. When we announced the deal, it was extremely positively received, and we saw our stock run to $7 during the deal. Mm-hmm. But as John correctly pointed out, there's been a significant downdraft in mining equities generally in the last couple of months. We've seen, on average, our peers go down 10 to 15%. When you remove that 10 to 15% performance in the sector generally, we've actually significantly outperformed as a result of putting these two companies together. And we've added significant value. Even at today's share price, the re-rate that we created for our shareholders is over 20% as a result of putting these companies together because of our relative outperformance against our peers who have gone down substantially more in a drifting summer market.
Okay. Great bird's eye view. Thank you for that, David. Question coming in around the Treasury here. With just over 10 million US in the Treasury, is Gold Royalty Corp expected to do a financing soon?
Well, as I alluded to a little earlier on, we're actually working on a line of credit that will give us additional firepower in order to acquire royalties. But we're in a great position where we're actually generating cash flow now. We're going to be adding to the Treasury from our existing portfolio of operations, our royalties on operations. And there's a burgeoning portfolio of operations that are coming through the development pipeline now that will add to a significant upward trajectory in our cash flow going forward. So we will look for accessing more capital as opportunities come in. And if we do access more capital, whether it's debt or equity, I can assure you we're going to do that with a view of doing something accretive. In other words, adding something that far exceeds our cost of capital, that is accretive to our shareholders on a per share basis, adds tremendous value.
Okay, thank you again for that. And we mentioned obviously the topic around the Prospector Royalty Corp transaction. With our eyes on the new deal with Prospector Royalty Corp, can you bring on arguments about why this deal is unique and will contribute to the growth of GROY stock? A $2 million deal should deliver great benefits, one would think.
John, please.
Yes, absolutely. I think what's so exciting about the strategic alliance, I think the investment itself was really to help facilitate growth of PRC itself. But really, I think where the interest should lie is in the strategic alliance that we have with PRC. And that alliance means any royalty of any substance that they discover through their proprietary database, we have the first right to look at and acquire that royalty or those royalties. It's a tremendously powerful tool. I'm particularly excited. And I think, again, speaking a little bit to our strategy here, our strategy is multi-pronged. We have, as I mentioned, in this portfolio, a tremendous amount of organic growth. But let's leave that aside for a moment. From an M&A standpoint, we will continue to acquire royalties on a bilateral basis, whether they be individual royalties or groups of royalties. Okay. Certainly, this is a tool that no other company can really compare to in terms of the quality of the database, the amount of information that has been digitized to identify royalties that heretofore are either orphaned or are just not known of, and comparing that to very, very detailed geological data gives us a tremendous advantage over our peers in being able to identify those royalties and pursue them and add them into our portfolio. That doesn't mean, as I mentioned, Mark, that we won't also pursue other growth initiatives. But this is just a very compelling avenue for additional growth for us.
Terrific. John, thank you for the walk through that. I appreciate it. Looking at some of the other investors in the game here, obviously Eric Sprott now has, I believe, 8% ownership in Groy. Has he indicated what he intends to do with his remaining shares in the company, gentlemen?
Yeah, I can speak to that. He's a long-term holder. He very much buys into the re-rate proposition that we have here. He's also a significant warrant holder. And I should add that prior to the closing of the deal, he exercised a large portion of his warrants and put more cash into the company and taken stock back. So he's a long-term supporter, and we're delighted to have him on the shareholder roll.
Always a good name to have behind the company. Thank you for that very much, David. Question coming in here. Do gold mining companies have a better handle on how to deal with higher input costs in general?
Well, I think by and large, they're going to be price takers, as they often are. They're price takers in terms of the commodity and price takers on input. And I think what's really going to squeeze costs up beyond just inflation in the general economy, which is definitely there and it's rearing its ugly head. We're seeing higher and higher headline numbers every day, is the fact that both base and precious metal companies over the last half a dozen years or so simply haven't been exploring and building to replace depleting reserves and production. Now they're both going to have to try to rush through that door and allocate capital in a significant fashion to reverse the downward trajectory in their production profiles. It's become an existential imperative for them. Given that they're going to be doing that, and they did the same thing 10 years ago, we saw double-digit inflation in input costs 10 years ago. We're going to see that again this time around. That's why I think it's so important that if you believe in gold as an asset class, and why wouldn't you in this environment of quantitative easing and low interest rates, why would you own anything than a royalty company right now to get that gold exposure?
Terrific. Thanks, David, for that. Let's talk a bit more about acquisitions here. Gold Royalty has voiced openly the desire to be a sector consolidator. Are there any royalty companies that Groy would be looking at to acquire next?
John, I'll let you stick handle that.
Yeah, Mark, I think it's certainly the job of a chief development officer to be very aware of every company in the sector. We do our homework. We certainly keep our eye on the quality of alternative portfolios, the quality of the management teams, the quality of the assets. But fundamentally, our overarching goal here is to create net asset value per share. We're not going to necessarily continue to consolidate the sector if it isn't going to create value for our shareholders. That said, there are a number of opportunities where we do see potential value creation, but it's very difficult to predict exactly where the next transaction is going to come from when there are a lot of factors that go into M&A. But I think it's worth speaking a little bit more about the whole prospect of re-rating further. Dave has mentioned the benefits of scale and the benefits of scale are more pertinent to the royalty sector than they are any other aspect of the mining sector, certainly in our experience and belief. But I think you also have to look at the quality of the portfolio and the quality of the management team. You can't expect a re-rating simply by virtue of getting bigger. So again, I think it underscores that we will continue to look at opportunities that will create net asset value per share and that will enhance the quality of our portfolio or enhance the quality of our management team.
Terrific. Thank you very much, Sean. I'd like to take an opportunity here because we've had the great pleasure of working with David and Trey through the lead up to the transaction, and obviously now that that's complete, and hearing your voice as a new voice in the space here, John, I'm curious, what are you most excited about as Chief Development Officer when you take on this task now in this new energy? What gets you most excited about the company these days?
I think it's the people. I mean, it is, as I mentioned, such a privilege to be adding both Jerry and Trey to our team. I've known Dave all my professional career. When Dave was first at Agnico Eagle as CFO, I was a banker. I had the privilege of assisting in some M&A transactions. When Dave was at Hudbay, I had the privilege of raising capital for him and advising him on how to finance the growth of that company. And then more recently, when he was the CEO of Gold Corp, together with Rick McCreary at TD, Rick and I were advising Dave on the merger with Newmont. So I've got a tremendous amount of respect and admiration for Dave. I'm so excited, as I said, I'll say it again, to be working with Trey and Jerry. We've got so many great tools at our disposal to grow this company, and that's really what is the most exciting thing. And even just having this portfolio where even if we hypothetically did nothing, there is organic growth that is going to really create a lot of value for our shareholders. But we're gonna supercharge that by adding to the portfolio through really sensible, well thought through M&A.
Terrific. I appreciate that, especially hearing your voice in the process here at this point, John. David, I'll ask the same question of you, because we've been doing town halls for many weeks now with you and Trey offering your perspective and really providing some peace of mind for investors as the transaction became closer. Now that you're on the other side of this, I'll ask you the same question. What gets you most excited about the energy of the company moving forward?
Well, like John, I'll echo the people part of it. It's a small, very nimble, and very experienced team, and it's fun to work with them every day. It's a real joy. I've known them all very, very well for a very long time, so we all know each other's strengths and weaknesses, and we complement each other. I think that's great. The other thing is, and I go back to this slide, is watching what our operating partners do and do well, which is to build mines, operate mines, and explore, and benefiting from their efforts. We get a little bit off the top. It's a little bit off the sweat of their brow, and it really creates significant value for our shareholders with not a lot of the underlying risk that they have as operators and mine developers.
Terrific. Thank you for that, David. I appreciate it. Let's move over to the market question here that's arriving. Is Gold Royalty Corporation intending to get a Canadian listing in the near future?
It's something we're always actively looking at, but what I would say is we enjoy tremendous liquidity on the New York Stock Exchange. Access to capital isn't an issue. We are a Canadian company that happens to have a U.S. listing. It certainly doesn't prevent our shareholders from buying our stock. It's the most liquid platform to buy the stock. Even if we had a Canadian listing, you're likely to buy the stock in New York if you're buying in size, just given that's where we raised our initial money.
Yes. Great. Thank you for that. For those that might still be waiting, the question, why have shares and cash not actually hit or entered their account yet?
Well, so my understanding is it is hitting it. It should have hit it. 26 is when CDS said you should have gotten credit for the exchange of shares and stock. If it hasn't, you need to speak to your financial advisor and let them know that you haven't seen it in your account yet. They're really responsible for ensuring and tracking down that you get the shares and cash that you're due as a result of the transaction with Ely. Okay.
Thank you for the housekeeping there. A question comes in as well, gentlemen. You outlined a $6 million US 2022 revenue forecast in your presentation. Where does this figure come from, and what makes up your cash inflow?
John?
That is actually a research figure. We currently do not provide guidance for cash flows, forecast cash flows. So it is a research figure. It does include approximately $2 million related to option payments from the maiden Ely portfolio. And then the balance is expected cash flows from the operating assets.
Okay.
But it is a fundamentally external research estimate.
Okay. Thank you very much for that. Another acquisition question here. If Wallbridge gets acquired, do your royalty rights survive with the new owner?
Yes.
Okay. Thank you for clarifying. Next question we want to get down to, why did I get more shares than cash? An investor asks here. I'd asked for all cash and was expecting either all cash or mostly cash with some shares, and it seems I received more shares than expected.
Yeah, so if you opted for the cash scenario, you would have gotten actually the majority of your compensation in cash, so well over 80 cents per share, and the rest came in the form of stock. And that would have aggregated to roughly $1.40 in total consideration between the two.
Okay. Terrific. Thank you. Another question here regarding the rate cannot be reviewed on market cap basis, given you haven't taken into account the new shares you issue. On the per share basis, the share price seems to have declined post IPO.
John, do you want to just maybe talk through the mechanics of the re-rate again?
Yes, I think, again, what one has to do is look at the performance on a relative basis. And I think, you can look at a specific peer group. In our case, we chose the GDJX index because it's an easy measure, it's quantifiable, and it's relevant. And, I think the slide that we had referenced indicated that index had declined 12%. I think if you look at individual stocks in the sector, they've declined anywhere from 10 to 15%. And when you actually look at the performance of our shares on a relative basis, we've outperformed that measure. And I think that's really where one needs to focus attention on share price performance, because there are a lot of factors, obviously, that will influence share price performance, not the least of which is gold price, but also just volatility in the capital markets in general. So it really does need to be a relative comparison, which is why we looked at that index as a basis for comparison.
Okay, terrific. Thank you. Question coming in here. What is your monthly and annual G&A?
Well, actually, our annual G&A or our monthly G&A is probably around $500,000 a month. And actually, the vast majority of that, believe it or not, is directors and officers liability insurance. Our actual cash compensation is extremely low.
Okay.
We deliberately keep our G&A costs low, but as a public company, particularly U.S. listed, those D&O insurance rates are exorbitant, and it's just a fact of life. Unfortunately, the majority of our G&A is insurance. Believe it or not.
Fair enough. Appreciate that. Going forward, will there be divides?
Sorry.
Just moving forward, the question. Yeah.
No plans at all for consolidations or divides or anything like that. No.
Okay. Thank you for that. Question comes in saying one of our investors here has warrants from Eli Gold, exercise price of $1, acceleration $1.60, and they're wondering how they've been adjusted in the conversion to gold royalty.
So, if you were entitled to $1,000 of Ely shares as a result of the conversion of your Ely royalties, you're going to be entitled to $1,000 worth of gold royalty stock as a result of the conversion. That's the way to think of it. The timelines to conversion are the same. There's no acceleration rates. We've removed those, so you won't get accelerated in the cases that you were under the previous regime. So in fact, that gives you more optionality. It's really, you're getting dollar for dollar the same consideration for a warrant. Obviously, the share number will be different because it's gold royalty stock now rather than Ely stock, but the dollar value of that stock will be the same.
Okay. Thank you, David. Just mindful of the clock. We're getting close to the top of the hour here, but time for a couple more questions from our audience. One here saying that gold mining retains a 28% ownership in gold royalty. Does gold mining plan to sell these shares to advance their own projects?
So the answer is absolutely not. Gold mining is a long-term investor, and you just have to look at the founder of gold mining's track record, Amir Adnani. He's a very, very patient investor. He's been cultivating a uranium business for 15 years when he was in his 20s, waiting it out patiently, and now he's getting some sunshine in the uranium business, and his shareholders are benefiting from that patience. And so I would look at that share investment that he has in gold royalties, potential source of capital. Maybe he might, borrow against a portion of it in order to finance and de-risk those assets, which would be to our benefit. If he de-risks the assets within gold mining and gets a re-rate on those assets, then we're going to benefit from that. But selling it is definitely not on the horizon for gold mining.
Okay, Thank you very much. We have a couple of related questions here. One saying that I know that gold-based assets are the core of Gold Royalties Inc., but what do you do when investors come up to you at the conferences and say, copper, copper, copper? A similar question asking about any potential interest in silver as another precious metal.
I would tell them I don't believe in alchemy. And so I can't turn copper into gold. And shareholders will see through that. I think, the rule of thumb is you should have no more than 20% of your exposure in other metals, and we're well north of 80% in terms of exposure to precious metals. Now, occasionally you get byproduct credits in your deposits. In fact, we have 5 billion pounds of copper exposure in gold mining portfolio, but those are byproducts to predominantly gold deposits. And so we're going to benefit from that copper upside, but again, the focus will remain precious metals because that's been demonstrated time and again to drive the highest multiples and the lowest cost of capital, which maintains our competitiveness.
Okay, thank you for that, David. Moving on, where do you estimate the company's NAV at current gold prices post the merger with Ely? And how much debt are you willing to take on if we don't see a meaningful PNAV re-rate soon to continue to grow the portfolio?
John, did you want to take a shot at that?
Yeah, we don't disclose our internal view of net asset value. I think one of the things that we're very focused on is to see a growth in research coverage, and that really is, in our opinion, the responsibility for developing a view on net asset value. We would feel that based on our own view of our value, that there is tremendous upside in our share price, and I think the intrinsic value of this portfolio. Again, I'll reiterate some of the comments I made before. We've got tremendous balance in near-term or currently producing assets that are in production, intermediate growth, and then long-term optionality. And the combination of this portfolio, it really is unmatched among our peers that are sort of in the sub-billion-dollar market cap profile. And the value of that portfolio is certainly, in our opinion, not being fully reflected in the market. So we see tremendous upside just in the intrinsic value of the portfolio today. You couple that with what we as a management team intend to do to continue to grow the company and to manage the business in a very responsible manner. We just see tremendous upside.
Terrific. Thank you for that, John. Again, really great to hear your voice in this journey. Thank you for all you've shared today. Gentlemen, I'm just looking at the clock. We're very close to the top of the hour here. I want to say thank you very much. This is why we're here, to bring the company and investors together to be able to hear the latest updates, but also provide a really solid and healthy Q&A session back and forth, which I think, once again, we've achieved. I want to thank everyone who's been watching from all points and offering some great questions. David and John, thank you very much for joining us once again in this new day at the company.
Thank you very much.
All right, folks. I know we'll hear from the company again soon. And as always, we'll be watching closely. So thank you, everyone, for your energy of being part of this event. I'll say my thanks once again to David and to John. We'll look forward to talking to you again soon, and have a great rest of the day. Bye for now.